2026 is already around the corner, and the main risk for a private trader right now isn't that markets might get more volatile. The risk is something else: living by the habits of 2024, 2025, and trying to trade like before, while the rules of the game are clearly changing. The global economy is entering a new cycle. Central banks are diverging in policy paths. The currency market is once again becoming the place where changes show up the fastest. Watch this video till the end, because I'll break down the 2026 landscape into a clear structure and explain what exactly to keep in mind so you can act with purpose instead of reacting to headlines at the last moment. Before we dive into the main points, a quick note about the practical side. In the description below the video, you'll find promo codes and bonus deposit terms. We prepared them specifically for channel viewers so you can start 2026 with more flexible platform conditions and manage your trading capital with greater ease. This isn't about promises or chasing quick results. It's about creating comfortable conditions for those who trade systematically and plan to stay consistent throughout the year. If you're planning to top up your account or rebalance your trading volume, make sure to use them. Now let's get to the main topic. What awaits us in 2026 if we take a broader view? According to the latest IMF estimates, global growth remains moderate, projected around 3.3% in 2026, but country trajectories will differ significantly. That means world isn't breaking, but power centers within it are constantly shifting. For the markets, that usually means not one big trend, but a series of midterm waves. The key factor in 2026 will be monetary policy. In the US, the market and major banks are increasingly pricing in the continuation of easing cycle. This matters because under such conditions, the dollar stops being an automatic magnet for capital. In the Eurozone, current forecasts suggest inflation will stabilize near the target. That gives the ECB room for a softer rate path. Germany, for example, expects fairly modest recovery in 2026. For the euro, that means higher sensitivity to growth data. Japan, as always, remains a story of its own. The Bank of Japan is gradually exiting its ultra-loose stance. Such uncertainty often becomes a source of strong yen trends. As a result, 2026 looks like a textbook environment for currency trends. Trade and geopolitical risks remain on the radar, and the forex market reacts to them faster than any other. Now, the practical part: how to act in 2026. First, don't rely solely on indicators. Technical tools are useful, but they only truly work when you understand market structure. In 2026, with policy divergence driving more trending segments, the best way to trade them is to follow the main direction and look for entries on pullbacks. That means you first identify direction through context and the structure of highs and lows, confirm the trend is active, and only then use indicators as filters for entry points. This sequence helps you avoid getting caught against the dominant impulse. Second, be cautious about trading right before or immediately after major news. Before central bank meetings or key data releases, the market often compresses, moves, gets choppy, and once the news drops, volatility spikes. During those moments, price can fly through levels without logic and snap back just as quickly. If your strategy isn't built specifically for trading on news, it's better to let the market digest information and wait for a more stable trajectory. This isn't about fear. It's about choosing an environment where your decisions have real statistical backing. Third, build your own shortlist of preferred instruments. Don't try to trade all pairs equally. You'll almost certainly notice that your results are more stable on certain assets. You naturally get a better feel for their character, volatility, news reaction, and correction pace. In 2026, this becomes even more important because the market will be more uneven in tempo. Pairs with strong rate or growth divergence will show clearer trends, while pairs with similar fundamentals will spend more time in ranges. Having your own shortlist helps you quickly read each pair's mode and save energy for what fits your style. Fourth, think in series, not single trades. 2026 will be packed with macro events, which means pair movements will often form in waves, impulse, correction, continuation. it's far more productive to work on one scenario through several entries while the backdrop stays intact than to chase one perfect entry. At the same time, risk control lays the foundation. Your goal isn't to catch every tick, it's to maintain form and follow your system. Put it all together, and the idea is simple. 2026 really can reshape the markets, not through a sudden shock, but through a new balance of forces. Rates are diverging, inflation is normalizing, and trade risks will occasionally come back into focus. For traders, that means more directional movement in currency pairs, but also a higher demand for discipline and context awareness. The ones who win aren't those who click faster, but those who better understand the changing market environment. And a quick reminder, this channel will help you stay up to date on every market cycle and phase. Under the video, you'll find bonuses and promo codes that add a boost to your starting deposit, especially useful if you're just beginning your trading journey. Subscribe to the channel. In the next videos, we'll break down key currency scenarios for 2026.